All right, welcome back. We're going to talk about a few wrap-up items related to receivables and cash. So it's important that companies have practices to minimize bad debts because that's the biggest risk of selling on account. Sure, we can estimate bad debt expense, but we really want to minimize it. We don't want a lot of deadbeats in our life. So one of the things we could do as a control to try to mitigate the risk of deadbeats is to require the approval of a customer's credit history by somebody independent of the sales and collections function. The reason you want them independent of the sales and collections functions is if you're a salesperson and you're getting commission, you'll be willing to sell to anybody with a pulse, right? If you just want to get that commission. So we want the person approving credit to be separate from the sales function. We also want them separate from the collections function because if I am collecting the money, I could potentially steal the money and then write off the person as a deadbeat to cover my tracks. So we need that segregation of duties in order to prevent that from happening. You don't want to give one person too much power. We should also age accounts receivable periodically to take a look at our customers that have the oldest balances because we know they're going to be our problem children and we need to entice them to pay. So we need to send in them notices and threatening them with collections to hopefully entice them to pay the amount of money that they owe us. And then we want to reward both sales and collection personnel for speedy collections so they work as a team. So we want the salespeople to reach out to the customers to get those collections. So maybe instead of giving them a commission on sales, we give them a commission on the actual cash receipts, which then incentivizes the salespeople to sell to people that are creditworthy and to follow up with their customers to make sure that they're paying. We're now going to talk about a ratio that can be useful in determining how easy it is to collect our receivables, and that's the receivable turnover ratio. So the receivable turnover ratio is net sales over average net trade receivables. Net sales would be the gross sales less those contra revenues we talked about, sales returns, credit card discounts, and sales discounts. And then average receivables would be beginning plus ending divided by 2. And net means it's net of the allowance. So if the receivables turnover is 11.4 as it is for Skechers, what that means is on average, Skechers collects its average receivable balance 11 times per year. As you can imagine, the more often we collect our receivables, the better. We want to have a high receivables turnover because the more often we're collecting our receivables, the quicker we're collecting them. So is 11.4 good? I don't know. You can compare it over time, and you can see that Skechers' receivable turnover is going up over time. That's the trend we want to see. We can compare with the competitors, and they're doing better than Wolverine worldwide, but not as good at collecting as Crocs. Frankly, I think that the receivables turnover is kind of hard to interpret. So we can convert it to days to collect account receivable by taking 365, the days in a year, divided by that AR turnover. So for Skechers, if we do that, it's going to be 365 divided by 11.4. Which gets us 32 rounded. So that's helpful for me to better understand if they're doing a good job or not. On average, it takes them 32 days to collect their receivables. Well, if they give their customers the terms of 30 days, they're a little higher than that, so that's not necessarily good. But again, we need to compare to others in the industry or from year to year. We want the receivables turnover to be higher. So that's up here, higher AR turnover, I should have wrote. So we want our receivables turnover to be higher. If that is higher, that's going to make days lower. So we want the turnover to be high, which is going to make the days to collect low. We want to collect our receivables more quickly, which means the number of days lower would be better. How do cash receipts from receivables show up on our cash flow statement? It's going to show up as an operating activity. You don't need to worry about this net income adjusted for changes. We'll cover that in the last chapter of the semester. All I want you to understand is that the cash we receive from our customers is in the operating section because it relates to revenues, and revenues show up on the income statement. And we learned way back in chapter 1 that any cash flows related to income statement items would be an operating activity for the business. The last thing we're going to talk about is safeguarding the cash. We talked a whole lot about receivables. Well, receivables ultimately are going to result in cash coming in the business, and we need to protect that cash because, as you can imagine, it's highly susceptible to theft and fraud. So what is cash and cash equivalents? Cash, you know what that is. That's money. Cash equivalents are investments with maturities of 3 months or less. So it's like almost cash. We can convert those investments very quickly to become cash. So because of that, we classify those short-term types of investments as cash on the financial statements. So cash would be money, money orders, bank drafts, checks, and then cash equivalents would be certificates of deposits with a 3-month or less maturity, treasury bills, which are short-term, bonds from the government. Basically, you can turn those in within 3 months and convert them to cash. So very, very liquid items. So how are we going to manage our cash? Well, we want to make sure we have accurate accounting so that the reports of cash flows and balances may be prepared. So we need to know where the money's coming from and where it's going to. We need to have controls in place to ensure we have enough cash to meet our current operating needs. In other words, we better make sure we have enough cash to pay the bills on time. And then we want to prevent the excess accumulation of cash, which may sound crazy, like I wish I had that problem. I just accumulated too much cash and that's a bad thing. But it is for a business because remember, businesses are not humans. They can't take that money, go on vacation, and do fun things. If they don't have any good use for the cash, they should give it back to the owners in the form of dividends. So they either reinvest it in the business or they give it back. Having it sit in a bank account doing nothing is not good for the business or for the owners. So that's what we mean by the accumulation of excess amounts of idle cash. That means the cash isn't being used for any valid business purpose. We need internal controls in order to safeguard our assets. The goals of internal controls for a company are to make sure that the financial reporting is reliable, that operations are running effectively and efficiently, and that we're in compliance with laws and regulations. Controls are designed to prevent errors and also outright fraud. Internal controls are usually reviewed by the independent outside auditor to make sure that they're appropriate and effective. Internal control procedures have to extend to all of our assets, but cash is the most vulnerable to theft and fraud, so we're going to focus on the controls related to cash right now. Separation of duties is probably the most important internal control a company can implement. As you can imagine, you don't want to give one person too much power because they can abuse that power. So we want to separate the jobs of receiving and dispersing cash. We don't want the same person involved in collecting and paying out the money. That would give them too much power, and they could manipulate the inflows and the outflows of the business to cover up potential fraud schemes and theft. We want to separate the procedures of accounting for cash receipts and cash disbursements. And we want to separate the physical handling of cash at all phases of the accounting function. In other words, the person who's actually collecting the money shouldn't be the one recording it, because they could steal the money and then hide it by having access to the accounting system. We also want to require that all cash receipts be deposited daily. That's really important. We don't want cash hanging around. People can steal it. When I was in industry, I had plenty of clients that had theft happen because they left the money around and didn't deposit it right away. We want to require separate approval of purchases and actual cash payments. You don't want somebody to be able to approve their own purchases, because then I can go buy myself something pretty and approve that purchase and have UNH pay for it, and we wouldn't want that to happen. We want to assign responsibilities for cash payment approval and check signing to different individuals. Again, that's segregating duties. We don't want to make allow somebody who can approve payments to also be a signer of checks, because then I could approve a payment and sign a check to myself. We want to also require monthly reconciliation of bank accounts, which reconciles the balance on the company's books to the balance held independently by the bank. All well-run companies need to have strong internal controls. Though the vast employees or majority of employees are trustworthy, thefts cost billions of dollars each year to businesses. A lot of times convicted felons say they stole the money from their employers because it was easy and no one cared. And companies need to have a code of ethics requiring a high standard of behavior so employees know what's expected of them. The bottom line is, anytime I dealt with a client and they said, oh, we don't need controls, we trust our employees, I could guarantee you I was going to find fraud, and I did. The biggest fraud that was uncovered by the firm that I worked for was perpetrated by a nun. So that's somebody you're supposed to hold up to a higher moral standard. So nobody put controls in place, and that allowed the nun to exploit it. Because I don't care if you're a nun, a priest, or anybody in a higher moral ground, you're all human, and we can all be susceptible to fraud. So we can't just rely on the trustworthiness of our employees. We need to make sure we have policies and procedures in place to protect our company from theft and fraud. A bank reconciliation is a great way to get comfort over the amounts of cash recorded on the books and that recorded in the bank. Remember, the bank is an independent source that verifies the amount that we have on hand. So we could cover up theft on the books, but the bank is going to show that the cash is missing. So that's what a bank reconciliation is used for. We're not going to go over how to perform a bank reconciliation in the class, though it's covered in the book. I'm not going to test you on it. I just want to make you aware that a bank reconciliation explains the differences between the book balance and the bank balance. And the reason there are differences are because of a variety of things. Outstanding checks, which are checks that we've written but haven't been cashed yet. Bank service charges, those show up on the bank statement but haven't been recorded on the books. Interest maybe that we've earned that hasn't been recorded yet on the books. Customers that bounce checks, that's going to mean that the bank doesn't show the cash, but we do on our books until we make an adjustment. And then deposit in transit happens when we make deposits, but it hasn't cleared the bank yet. Those would be all the valid reasons for there to be differences. If those do not explain the difference between the book and the bank balance, then we know that something else is going on, like some fraud or errors have occurred, and we need to investigate it further. So a bank reconciliation is an important control to make sure that the balance that's recorded on the company's books is in line with the balance that's recorded in the bank. And we do these reconciliations to deal with these potential reconciling items, and anything that isn't explained by these reconciling items needs to be investigated because it could be an indicator of fraud or theft. Or it could be errors by the bank, potentially, or the company. So it's not just fraud, it could also be the result of errors. Either way, we want to figure out what's going on so we can fix it. And that's it for Chapter 6. As with all the chapters, I'm sure there would be things that you don't understand. Please reach out on the discussion boards, and please utilize all of the resources available on both Connect and Canvas for practice. Practice makes perfect in this class, and without it, you're not going to succeed. So please, please, please practice. And if you have questions on the practice material that's available, use those discussion boards to get extra help.